In this uncertain phase for the markets, how do you think high yields will perform?
Investors in high yield will benefit even despite the volatility in the marketplace for a couple of reasons. One is the consistent power of income that the asset class delivers. So for investors with a medium to long-term time horizon, they have a strong contribution of the income component in high yield will deliver them reasonable returns over time. The risks are illiquidity and volatility in the asset class generally need to be managed because credit of any form, whether it's investment grade or high yield, is always subject to an asymmetric risk. And clearly, high yield companies are more highly levered than investment grade companies, and therefore that much more geared to changes in earnings or operating income, and also less liquid in terms of the depth of the marketplace. So investors need to be cognizant of the asymmetry of risks in high yield and choose to go into the market in a way that is disciplined in terms of the size of a bet in any individual name, and also the discipline around reducing risk and minimizing those threats to returns that are generated by the strong production of income.
In this uncertain phase for the markets, how do you think high yield will perform comparing to other asset classes?
Risk-adjusted returns in high yield are quite strong at the moment. There's a couple of reasons for that. One is financial repression in the marketplace is driving investors to seek higher yielding investments. So spreads and yields on investment grade credit have come down to historically very, very low levels indeed, and are producing returns that are nominally in the 1%, 2%, 3% range, but on a real return basis, adjusted for inflation, don't offer that much additional premium. High yield yielding 6 to 7%, depending upon the quality of the high yield that you're looking at. Let's say 7% on average at the moment for global high yield, still offers a reasonable return because of the strong balance sheet characteristics that we see for companies in the high yield universe, particularly non-financial companies, are currently operating at a level of net balance sheet leverage that is lower than it ever has been historically. So balance sheets are quite sound. The refinancing profile for high yield companies is also not particularly challenging. So quite different from the atmosphere that we were operating in during 2007, 2008, when the financial crisis first hit. There was a mountain of maturities of high yield companies, either in high yield bonds or leveraged loans, that needed to be refinanced in a very short period of time. Presently, high yield companies are not facing a substantial refinancing risk. Indeed, there's not a large amount of refinancing to be done in the leveraged finance market until 2014, 2015. So supply and issuance is not a threat either to the market at the moment. Thirdly, and lastly, the correlation characteristics of the high yield asset class are one that are forcing more and more people to reconsider their preconceptions about high yield. Now, clearly, it is a risky market, but the correlation of high yield over the last 25 years to the equity markets is at about 0.6. In a risk-on, risk-off, illiquid environment, I think our assumption is that it will actually be a little bit higher than that. But even more importantly, from a fixed income investor's perspective, the correlation of high yield returns to government bond yields is very negligible indeed over time. And so for investors who are concerned that interest rates are going to make substantial moves in either direction from here, we can't obviously fall that much more with in the short end with rates close to zero, but long rates could still come down substantially. That shouldn't have a negative impact on high yield. Conversely, many investors are concerned about the end of extraordinary policy measures from global central banks, implying that interest rates will rise substantially or normalize to some higher level in perhaps dramatic fashion. That will clearly have an impact on all risk markets, but high yield over time has demonstrated that it's reasonably resilient to substantial shifts in interest rates. So those three factors combined are really reinforcing the investment case for high yield as an asset class.
What kind of characteristics you seek in the paper you pick for your portfolio?
we look out for a couple of key characteristics in investments that we want to take a position in high yield. First and foremost, there's fundamental conviction with respect to a company's balance sheet soundness, its leverage profile, its earnings capability, its business position within its industry, whether or not it has a competitive advantage in technology or process or simple market position. All these things are the beginnings of an investment case. Then next we need to look at where we stand at the capital structure for a highly levered company. Can be quite important as to whether we buy a senior secured note or an unsecured junior piece, or perhaps even what's called a PIK note, which is very much like equity. So we need to make our choice with respect to how much exposure to the leverage of the company that we want. We then need to think about the relative value that's on offer at those different levels of the capital structure for that credit compared to other similar credits in its sector globally, regionally. And we also need to think about what we're getting in terms of spread per unit of leverage for the rating characteristics of any given company. Those are all some of the basic metrics that we need to make a decision about before we invest. At the moment, what I'm really focused upon is finding ideas with high conviction, good analyst visibility, strong relative value prospect, and a reasonable global diversification of earnings power and thereby deleveraging power. And I'm thinking about that in the context of a market which I believe is subject to some increased dispersion and widening risk for the more highly levered names. So I have a bias towards quality in the portfolio now, and a bias towards quality that is globally diversified.